Hello everyone, welcome to NxtGen Money. My name is Shantanu, and in today's video we will talk about mutual funds, how to invest in them, what are the pros and cons, and what are things that you need to keep in mind. And also at the end of this video I'm going to be sharing with you the mutual fund that I'm currently investing in. So do watch this video until very end. Let's start the video. So what is a mutual fund? Well, to understand this, I'm going to give you a small example. So let's say you want to go from point A to point B and you have an option of driving. So you have your own car wherein you decide which way to go, the way you decide which speed to drive your car in, if you want to take any stop in the middle or not, how much time you want to take to reach your destination. So all kind of decisions when you're driving in your car is basically made by you. So in real world, when you're investing in stock market, you are basically going out to the stock market, doing your own research, finding out the stock to invest in, and you buy the stock when it is right time to buy and sell the stock when it is right time to sell. So basically when you're investing in stock market, you are doing all the homeworks and all the decisions that you are making by yourself. Now going back to the example, you want to go from point A to point B, and this time you are hiring a professional driver. So in this time, the professional driver, when you are hiring him, it's his decision. He's the one who is making the decision, which speed that he want to drive in, how much time he is gonna take, and he also deciding if there is any stop that he wanna take in or not. But ultimately he also will reach the destination B. So in the real world, in mutual fund, it creates a pool of money. People like me and you give our money to the fund manager, wherein the fund manager decides which stock, which instrument to invest in, whether to invest in equity, whether to invest in debt, whether to invest in both of them, and when to sell the investment, and all kind of financial decision basically is made by the fund manager. In exchange, the fund manager charge you a little bit of professional fees, and normally known as the expense ratio. In India, the expense ratio is somewhere between 1 to 3%. So just keep that in mind. So I hope you understand basically what mutual fund is basically professionally managed fund, professionally managed stocks, where a fund manager make all the decision on behalf of you. Well, let's move on to different kinds of mutual funds. Security Exchange Board of India, or SEBI, has categorized the mutual fund into 5 main categories. The first thing is equity mutual fund. The second is hybrid mutual fund. The third one is debt mutual fund. The fourth one is solution oriented mutual fund. And the fifth one is index fund or others fund. Well, in equity fund, where your money completely goes in the stock, where a fund manager decide which stock to invest in. In hybrid mutual fund, where the fund manager invests your money in stock, in equity, as well as in debt instruments. In debt mutual fund, all your investment goes into debt instrument like government bonds or treasury bill, where the investment has very low risk secured by the government, but the returns are very low. A solution oriented mutual fund is basically those like let's say your retirement mutual fund, or child's education mutual fund, or child's marriage mutual fund. So these are the solution oriented mutual funds. And the last one is index fund. There is a famous personal finance blogger, his name is Varun Malhotra. He always advised that first time investor always should invest in index fund, where what happened in index fund is basically it follows an index. Whatever money you give to the mutual fund house, they straight invest your money to the Nifty or to Sensex. So basically there are 3 key factors when you make an investment. So let's understand that. The first thing is return, second thing is risk, and third thing is time. So these 3 factors always associated with each other. So if you have lower risk and longer time, your return will be low. if you have longer time, higher risk, your return is gonna be high. So typically, if you think about a bank investment or an investment that you make in post office, wherein your investment, the time horizon is 5 to 10 years, just because you have low risk in those investment, your returns are very low. On the other hand, mutual fund investment, if you give it a time of 5 to 10 years, maybe you're gonna have a little bit of higher risk, but your return is also gonna be higher. So why you should invest in mutual fund? Well, in India, the inflation rate is somewhere around 5 to 6%, where if you invest your money in bank FD or in post office, you will be generating a return of 7 to 8%. So your actual return when you deduct the inflation would be 2 to 3%, which is not enough to become financially free or financially independent. To become wealthy, you need to beat the inflation. To beat the inflation and to maximize the return, every investor, every young people, every young generation should invest in mutual fund, wherein they can maximize their return. Typically, if you look at the graph of Indian mutual fund market or Indian stock market, let's say a 10 years graph, you will easily see that Nifty or Sensex, they have given more than 10% return in past 10 years. So that means this return is much more higher than fixed deposit or post office deposit, which makes you much more wealthier than savings in bank or in post office alone. Oftentimes there is a question like which mutual fund to invest. Let me give you an example. Now, can you tell me which car is the best car? The answer would be different for person to person. If you have a big family, maybe you need a 6-seater car. If you have a small family, you need a small car. It depends if you're looking for a mileage or if you're looking for a performance. So it's all depend upon your personal taste. On the same way, in mutual fund, it's all depend upon your risk profile. So if you have time horizon, if you can give time to your investment, you should go for equity mutual fund, wherein your money goes into a large cap mutual fund or a mid cap mutual fund, where you give your time, let's say 5 to 10 years, where your returns are higher, where you have to invest your time. On the other hand, if you are looking for an investment for next 2 to 3 years, then you should go for a debt mutual fund, where your investment is much more safer. The return that you're gonna get is a little bit better than a bank or post office investment. So when you're making a mutual fund investment, is all depend on the risk appetite, how much risk, how much time that you have, and then you can make your decision. So it is commonly advisable that you invest in equity mutual fund. There are many different kinds of equity mutual fund. The first one is large cap mutual fund, wherein a fund manager put all your money in top 50 or top 30 large cap companies. These are the companies which are well established in the market. They have very nice track record, so you can depend on the performance of this fund. The second one is mid cap fund, wherein the mid-sized companies a fund manager choose, wherein your returns are a little bit better than large cap fund, but on the other hand, the risks are much more higher than investing in large cap fund alone. The third category of equity investment is called the small cap fund, wherein your investment goes into small cap companies, but these companies are very risky. Your investment can go down like a rock and it can go up like wind. So the fluctuation is very high. So if you are new in investing, it's recommended not to invest in small cap. So if you want to make an ideal portfolio, have 80% of large cap fund and 20% of mid cap fund in your portfolio, and you can begin with your mutual fund journey. So let's talk about the pros and cons of mutual fund. So the pros are it's professionally managed, wherein you don't make any decision. The decision is made on your behalf by the fund manager, who is dedicated just to look after your money. Second thing is highly regulated. It's very transparent by SEBI, Security Exchange Board. Mutual fund also gives you high return than bank deposit or post office deposit. Let's talk about the cons of a mutual fund. Well, mutual fund has its own expense ratio, typically from 1 to 3%, where a mutual fund manager, just because it's his professional fee, let's understand it in that way. And it also have a fluctuation when market crashes and sudden downturn comes in the market, your investment value can go down. But again, just keep it in mind, when you give a time limit, a time horizon with your investment, you're holding it more than 7-10 years, most likely you will end up with positive return, which is much more better than investment in bank or in post office. I hope you understand what mutual fund is and the basics of mutual fund. So you can go ahead and start your investment journey. Look for online platform. You can do your KYC, know your customer forms, and do those formalities. Also, you can go to the AMC's website, like ICICI Mutual Funds website or Axis Mutual Funds website, and register yourself, and you can start your investment journey. Now it's time to tell you my favorite mutual fund that I'm currently investing in. Is called Parag Parekh Long-Term Equity. This is a multi-cap mutual fund, and the best thing about it is it also invests in foreign securities. Companies like Google, which is also known as Alphabet Inc., Facebook, 3M, Nestle. It gives me the international exposure. So this is why it is my favorite. So let me know which mutual fund that you are currently investing in. And if you like this video, go ahead and click the subscribe button and the thumbs up button. It's a huge motivation for me. This is Shantanu from NxtGen Money. I'll see you guys in the next video.